In September 2008, the United States government faced a decision that no government had ever faced before. The global financial system, the network of banks, loans, investments, and credit that keeps the entire world economy functioning, was on the verge of complete collapse. Not a recession, not a market downturn. A complete seizure. A global financial system that stops working. Cash machines that stop dispensing money. Businesses that cannot make payroll. Supply chains that break down because companies cannot get credit. A world that, within days or weeks, could not function as a modern economy. This was not a natural disaster. It was not a war. It was not caused by something that happened suddenly and without warning. It was the deliberate, systematic, and almost universally approved result of decisions made by the most respected financial institutions in the world over many years, in broad daylight, with the knowledge of regulators, ratings agencies, governments, and investors. By the time it was over, more than $8 trillion in American household wealth had been wiped out. 8 million people had lost their jobs. Millions of families had lost their homes. Not a single senior Wall Street executive went to prison. This is the story of the 2008 financial crisis. The crisis of 2008 did not begin in 2008. It began much earlier with a simple and seductive idea. After the dot-com bubble collapsed in 2000 and the economy slowed further after September 11th, the Federal Reserve cut interest rates aggressively. By 2003, the federal funds rate was at 1%, the lowest in 45 years. Low interest rates meant cheap mortgages, and cheap mortgages meant more people could buy homes, and more buyers meant rising home prices. And rising home prices created a belief shared almost universally across the American financial system that home prices would keep rising forever. This belief was wrong. It had always been wrong, but for nearly a decade, nobody important wanted to say so. Into this environment came a new kind of mortgage, the subprime loan. Subprime mortgages were loans made to borrowers with poor or no credit history, unstable income, and little or no down payment. Some of these loans were called ninja loans: no income, no job, no assets. Lenders would extend mortgages to people who could not remotely afford them, with interest rates that started low and then ballooned dramatically after 2 or 3 years. The assumption was simple. By the time the rate increased, the borrower could refinance because their home would be worth more. Banks originated these mortgages and then immediately sold them in bundles of thousands to investment banks on Wall Street. The investment banks packaged these bundles into new securities called mortgage-backed securities, or MBS. They sold slices of these securities to investors around the world: pension funds, insurance companies, foreign banks, sovereign wealth funds. The critical feature of this system was that no one in the chain had an incentive to care whether the underlying borrowers could actually repay their loans. The mortgage broker got a fee when the loan was originated. The bank got a fee when it sold the loan. The investment bank got a fee when it packaged and sold the security. By the time the loan defaulted, it was somebody else's problem. But there was a problem. Most investors, pension funds, insurance companies, conservative institutions were prohibited by their own rules from holding risky debt. They could only buy investments rated AAA by the major credit rating agencies. So Wall Street invented a solution. They took the riskiest slices of mortgage-backed securities and repackaged them into a new instrument called a collateralized debt obligation, a CDO. Through a process of mathematical modeling, the CDO allowed banks to take a pile of junk-rated debt and transform most of it into AAA-rated securities. On paper, the ratings agencies Moody's, Standard & Poor's, and Fitch gave these instruments their highest ratings. They were paid by the very banks whose products they were rating. The more CDOs they rated AAA, the more business they received. The conflict of interest was not hidden. It was simply accepted. A fund manager named Michael Burry was one of the first to look carefully at the actual mortgages inside these securities. What he found horrified him. In 2005, he began buying credit default swaps, essentially insurance contracts that would pay out if the securities failed. He was betting that the entire system would collapse. Investors thought he was insane. Goldman Sachs, Deutsche Bank, and others happily sold him the insurance collecting premiums they expected to keep forever, on risks they believed were virtually impossible. By 2007, Burry's fund had made nearly $600 million for its investors and $2.7 billion in total profits. He was not insane. He was the only person in the room who had actually read the contracts. In June 2007, two hedge funds managed by Bear Stearns, both heavily invested in subprime mortgage securities, collapsed. Bear Stearns injected $3.5 billion to bail out one of them. The other was simply shut down. Investors lost everything. This was the first public crack. But the official position from Wall Street, from the Federal Reserve, from the Treasury Department, was that the problem was contained, that it was isolated, that the broader financial system was sound. It was not contained. In March 2008, Bear Stearns itself, the fifth largest investment bank in the United States, ran out of cash in a matter of days. The Federal Reserve facilitated an emergency sale to JP Morgan Chase, assuming $30 billion of Bear Stearns' worst assets to make the deal happen. Bear Stearns shareholders, who had owned stock worth nearly $170 a share a year earlier, received $2 a share. Then came September. On September 7th, the U.S. government nationalized Fannie Mae and Freddie Mac, the government-sponsored enterprises that had guaranteed trillions in mortgage debt. On September 14th, Merrill Lynch was sold to Bank of America in an emergency weekend deal. On September 15th, Lehman Brothers, with $613 billion in assets, the fourth largest investment bank in America, filed for bankruptcy. It was the largest bankruptcy in American history. The day Lehman filed, global credit markets froze. Banks stopped lending to each other because nobody trusted anybody else's balance sheet. The commercial paper market, through which companies borrow short-term cash to make payroll and buy inventory, began to seize. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke went to Congress and asked for $700 billion, the Troubled Asset Relief Program, or TARP. Paulson told congressional leaders that without it, the American economy might not exist by Monday. Congress initially rejected TARP. The House of Representatives voted it down on September 29th. The stock market fell almost 777 points, the same day the largest single-day point drop in history at the time. 4 days later, Congress reversed course and passed the bill. President Bush signed it on October 3rd. The bailout stabilized the financial system, but what followed was devastating for ordinary Americans. The Great Recession officially began in December 2007 and ended in June 2009. But the damage lasted far longer. More than 8 million Americans lost their jobs. Unemployment peaked at 10% in October 2009. Home prices fell by more than 20% nationally. Millions of families went through foreclosure, losing the homes they had been sold on loans they had been told they could afford by institutions that knew the loans were defective. The banks that had caused the crisis were bailed out. Some of them became larger after the crisis than they were before it, consolidating weaker rivals at fire sale prices. Their executives kept their jobs. Their bonuses were paid. In 2009, Goldman Sachs paid out $14 billion in compensation and bonuses, its second highest total in the firm's history. In the years following the crisis, the Department of Justice did not bring criminal charges against a single senior executive from a major Wall Street firm. Civil settlements were reached with multiple banks, totaling hundreds of billions of dollars in fines paid by the bank's shareholders, not by the individuals who had made the decisions. The one prominent figure who did face criminal prosecution was Karim Sarageldin, a Credit Suisse banker who was convicted in 2013 for hiding losses on mortgage bonds. He served 2.5 years in prison. He was the only banker to serve prison time for conduct related to the financial crisis. One person. The 2008 financial crisis was not a natural disaster. It was not an accident. It was the predictable consequence of a system where the people who created the risk bore none of the consequences. The mortgage brokers made money on origination. The banks made money on securitization. The ratings agencies made money on ratings. The investors made money until they didn't. And when the entire structure collapsed, the losses were distributed to millions of people who had never heard of a CDO, who had never owned a share of stock, who had simply worked a job and paid a mortgage and trusted that the system was what it appeared to be. The financial system recovered. The people who broke it, largely, did not suffer. The people who trusted it, largely, did. This was Dark Ledger. Subscribe if you want to know where else the money really went.